All right. How's everybody doing? It is the first of the month, December. Cyber Monday's tomorrow. Everybody just finished Thanksgiving. I hope everybody had a great holidays. Um, if you're not done shopping tomorrow, you could still continue. I have some things, Christmas presents I had to get. But um, but yeah, today I wanted to go over inverse fair value gaps. This is an interactive class, so whoever wants to unmute themselves, ask questions. If it's not making any sense, then feel free to do so. This will be recorded, so I'll post this in the Discord for members. So let's go ahead and get started. So I always talk about fair value gaps. So we'll just take a look at the charts real quick. So fair value gaps, everybody knows, are used for support and resistance, right? So usually what happens is that we look for fair value gaps in areas where we expect price to bounce. Okay, let's just try to find a fair value gap. Where's the fair value gap? Oh yeah, we have one right here. All right. So fair value gaps are three candle structures. We have one right here. You can see price is making new highs, and we use these fair value gaps kind of as support. And when the body continues to hold above it, then we know that price wants to use this as support and possibly deliver higher to internal liquidity, potential external liquidity. And we're just using it as a tool, right? We need multiple confluences, but we use them as a tool to uh to take us to where we want to go, right? Does it always go there? No, yes, no, right? So right here, this is an example of how, depending on the time of the day, like this is overnight, that price might not be as efficient. So when we want to trade during the hours where price is efficient, and you'll see that price does respect its levels. This is an example of one fair value gap that doesn't work, but when it does, this is an example of one that does. During this one, you can see this is when the market actually opens at 7 Pacific time. So if you're in the East Coast, it's 3 hours ahead, right? 6:30 is right here. This is when the market opens right here. We create a fair value gap. We break structure. So it's a time of the day where you want to use fair value gaps to actually create a more efficient price action. Right here is overnight. Right here, you can see 16 o'clock, 18 o'clock, 19 overnight. You can see how it's just the candles are smaller and it's less efficient. So that's why it's important to make sure you find out what time of the day you want to trade. Some people trade London, some people trade Asia, some people trade New York AM, sometimes people trade New York PM, and there's power hour. So you got to find which hour gives you the most efficient price action for you to understand. There's no right or wrong time to trade, but as people know, the New York is where you get the most volume. And if you can see right here, we get our sweep. Usually in fair value gaps, we look for sweeps and we use them as a support or resistance or an area for a target, right? So this is a support. And when you enter here, we get a sweep. And then you could try to enter around here. Stop loss is below the fair value gap. And our target is where? Is internal highs first, and then external highs second. Okay, that's just the gist of how to use fair value gaps. Okay. So today I wanted to go over inverse fair value gaps, right? So when is the support, when it's broken, what do we do? What do we do when and why does it break? Okay. So I had an example of candles that I just kind of just drew while waiting for this class to start. Where is it? Right here. Okay. So this is an example of why a fair value gap may break. So this is an example of a fair value gap right here. If you guys can see it, we have a fair value gap right here. And as you can see, it got inversed, right? This is like a morning star pattern. But the reason why in this situation, we're just taking this at face value. We have no other candles to give us any other bias, but just by looking at this alone, what do we see here? And why is it okay now to anticipate that price can move higher in this situation just by all the candles we see. Does anybody have any ideas? Feel free to mute yourselves. If not, I'll just continue. I'll give you guys just a minute to take a look at it. Why is this one okay for us to potentially reverse here? You drop it on the chat too if you want to, if you guys are busy or something. So I get an idea of your thought process. You guys hear me? Hello? Okay. I think it's working. All right. So right here is one indication to let me know that we could potentially change price direction. We had a liquidity sweep right here. That's why I encourage everybody to label your charts. Oops. We have a sweep right here at the bottom. So when we have sweeps, usually it likes to do some type of bounce. But if this was the external range and we got a bounce here, we had a fair value gap right here, and we inversed it. So now we could use this as a potential resistance now turns support. So we can expect price to potentially bounce. Oops. I just switched colors, that's why. We can expect price to potentially use this as support to take us to our target. Okay. So this is one way to use an inverse fair value gap where we get our external sweep and we break it and we want to see how price. Now we have another fair value gap on top of a fair value gap right here, right? This is a fair value gap and this is another fair value gap. Okay. So this is one way to use an inverse fair value gap. Okay. Another way to use it is if we continue this structure up and we break this structure. So we go higher and then we return to the fair value gap. And there's a higher probability if this range happens to be in discount. Okay. This is called the unicorn setup, where we have a sweep, a newer high, break a structure, returning to discount fair value gap to take us higher to our targets. So the goal is just to look for liquidity here once liquidity here is taken. And the fair value gap in the middle is letting us know that once we sweep and it breaks, then now it can now be resistance. Okay. But we have to understand though that the one pattern that I hate the most is pennants. So we have to identify that early. So if this happens, sometimes you'll see a fair value gap get inverse. You're like, oh, it should go up. EW says it should go up. But then it just does this, right? It just turns choppy. So it's your job to zoom out if this is happening to you and identify are we in a downtrend or uptrend on a bigger time frame? But at face value, this was how we identify a trend reversal as we get a sweep, this and that. But sometimes it does get choppy, just like we saw on the price action of an overnight session. Remember how we saw the overnight session? It was like, oh, it should go, this fair value gap should go, but it doesn't, right? Like this is an example of an overnight session, right? Right here. 19, 20, 21, 1, 2, 3 in the morning, right? And look at how these fair value gaps are just not efficient. Okay, we have a fair value gap here, you get inversed, inversed again. So, but well, this is actually a good example, actually. No, I already got swept, right? We had a fair value gap right here, we broke. It should be support to go higher, but it breaks, right? It's just overnight session. So it's important to, when you guys are identifying this and doing some back testing on your own to learn about inverse fair value gaps, because hopefully whatever I teach you, you're trying to find it for yourselves when you're on your own to get better instead of just learning whatever you see here in class and then trying to just apply it right away to your trading, right? You obviously want to go back, look at past data and analyze how fair value gaps work, right? I just wanted to point that out. Any questions so far? Let me see the chat. I think someone wrote something in the chat. You declare that based on the second red candlestick. Let me go back. Where are we at? These. What was the your question, Queasy? When you said declare that based on the second red candlestick? The fair value gap? Yeah, because there's a gap right here, right? There's a wick, body, and then a wick. So it's a three candle structure that leaves an inefficiency in the middle, which is just the separation between this candle and this candle's low. So there's a gap. That's the fair value gap right here. So if we never swept right here, then I would expect this to eventually break again to take us there. So that's why it's important to know where the overall objective is. But the reason why I had this like this, now that's letting me know that this inverse fair value gap has a better chance of holding. But if it never swept, there's a lesser chance of holding unless we have an SMT where ES already swept and NQ didn't sweep, then this could be respected. But if ES and NQ did not sweep, then I would expect this to come right back down and break it. Maybe sweep one more time up here and then come down. But since we swept, that just changes the narrative, right? You need checks and balances. This would change the narrative as like we got a sweep. So now we got an inverse fair value gap. I can anticipate, I mean, it's not going to look completely pretty, but I'm going to anticipate that price does some type of work right here and takes us higher to here because the overall objective here is taken. So we got to ask ourselves, is the overall objective taken? Where is the overall objective? Right? Price does those three things. It goes towards liquidity, it generates liquidity, and it moves towards inefficiency. And there's four things. And then it rebalances to equilibrium. So if this was overall range, right? And let's say there was more candles. Let's just say there was a lot more candles and we're in a range like this. I would expect price to rebalance to inefficiency or equilibrium. So let's get it even higher. Let's get that even higher. Let's say it was all the way right here, right? I would expect price to go to back to inefficiency. I mean, back to equilibrium of the range that it came from, right? If we had a high right here and then we bled all the way down here and we swept, I want price to come back to 50%. And I think that's actually what happened in the what I was calling out this week. So sometimes you might have to just wait for the perfect situation, and then you could just capitalize on your position size with that. Okay. So second thing I wanted to go over is fair value gaps being broken as support. So I think this was the 30 minutes. Yeah, 30 minutes. So this is an example. This is one of the ones that I like as well. Excuse me. All right, this is one of another fair value gap inverse that I like is that I use it as support to break, right? And sometimes I would lose. I think I lost last Friday on a trade where I was expecting a bounce, but we have to anticipate that sometimes, if we look at the overall narrative, right? We push up, and it needs to do some type of rebalancing, right? It needs to come down and take some type of liquidity, right? There's some empty fair value gaps down here, rebalance, right? Down here. So we know that when we have a fair value gap like right here, and we see slowly momentum coming down, this is one of the things that I tend to see quite often is though you think it's gonna be a bull flag. You think it's gonna be a bull flag. We have our sweep here. We didn't sweep right here, but we're pushing up. We had a sweep right here. But we would want, right, just by this, just how this looks like a pole, lower highs and lower lows for price to break out for a bull flag. But it doesn't always happen. So when it gets invalidated, that is where it becomes an inverse, right? So no one knows 100% of the time where price is going to go. So there's always rules of if this happens, then that should happen. If this happens, that should happen, right? So we have our fair value gap right here, right? We push up. We did have a high that was swept. That's understandable. But we want price to go up. But when we notice that price starts coming down, right? Here's this liquidity right here. There's liquidity right here. We had one more sweep. So once price is breaking our fair value gap support and closing, it's going to move pretty efficiently, right? And you can see how price comes down. And I said, what does price do? It moves towards inefficiencies, which are fair value gaps. It moves towards liquidity. It generates liquidity and it rebalances to equilibrium. So when the price is falling here, I'm expecting price to at least get me to equilibrium. So this is a support of a fair value gap. We established a high, and then when we start breaking the support, I could expect us to at least take us to equilibrium. And I look for liquidity just under equilibrium, or I look for fair value gaps under equilibrium for my targets. Oops, right here, right? Look for fair value gaps right here. Fair value gap. We had a three candle structure. Three candle structure, 1, 2, 3. There was a separation. This fair value gap was used to push us higher right here. So when we come down, we're using this as also a target. Target here, boom here, inside 50%. And then once it's already here, now you can't look to really, I mean, you could look for shorts, but I mean, we're in discounts for longs now. Okay, does that make sense? So that's just two ways to use it, right? We use it inverse to, well, it's the same, it's to invalidate the structure. This is a support. It's broken. We're gonna dump straight to there. And I think that's what I called out on my I think it's this one, right? I called out on my channel. Let me open up my Discord channel. Let's see where I had this. Excuse me, I'm pulling it up. I'm gonna switch the channel. Okay, screen share Discord. You guys see this? It's a little sloppy. But we had this fair value gap right here. I don't know if you guys can see it. Just look at the structure, right? We break, and we immediately dump. Right? We break the support right here, retest, and we dump. And we go straight for liquidity. And what I said in the channel is that go short until the target is hit. Right? So we go short. This was the fair value gap. This is the fair value gap that was holding as resistance, right? And then we eventually hit our TP. And once we hit our TP, we hit equilibrium, right? We hit equilibrium, 50%. And what did I say? So we see if we could bounce here or continue to sell off. We have to have patience. But the equilibrium is where we decide, we look for longs, right? We broke out, we came back to equilibrium. And the long doesn't mean we go straight to the highs. The longs means we could just have some type of bounce, creating a bear flag, but that gives us points coming back up, right? So once we hit our equilibrium right here, I posted this, we had a sweep. So just by analyzing here, we had a sweep, lower low, sweep. And so if we do sweep, what does price want to do? I said rebalance. It likes to rebalance the equilibrium. So when price was breaking and creating new highs, look what I drew. We had equilibrium. So when we had our high established, we had our sweep down here at a fair value gap. All right, and we're breaking structure. Is it too late? Well, price likes to go towards equilibrium. So it gives us what? When I showed this one right here, it was 66 points, right? And look where it takes us all the way to 812. So it's like over 50 points, and it still had more room. And look what happens when it hits equilibrium, right? We hit equilibrium, we chop around a little bit, we sweep, and we just chill out a little bit. But that's the target, the range, right? We established a high, established a low, and in here, there's probably a fair value gap that gets inversed. And why is it okay that if it's inversed right here for price to continue up? Is because we met our objective, right? We swept this white line. We had a smaller time frame sweep, this 5-minute sweep, and price rebalanced the equilibrium. So if we could just create these rules for ourselves, then price can be a little bit more clear. Remember, we have to look for the time of the day to trade. That gives you the most efficient price action. And we need to look where the price is drawing to, which where's the liquidity? Was it swept already? And if it was swept, then we should expect the fair value gaps to get violated going the other way. If it's not swept yet, we're going to keep using the fair value gaps to take us to where we need to go, right? So right here, fair value gap, sweep, higher lows, then we can expect fair value gaps to get inversed. So let's say we have inverse, we have fair value gap right here, right? It's not the prettiest because obviously this is, overnight, but you could see the what's happening right here, right? Right, a fair value gap right here gets broken. And again, another one right here. Let's see this one. This is fair value gap. You guys can see that. Let's make this one red, right? And we inversed it because we swept. So when we sweep, we can expect price to go the other way. So we have a fair value gap right here, right? We inversed it, we held it, and it takes us to our target right here. And it's making its way back up, right? Making its way back up. So where can we anticipate for price to want to go is if we can break this fair value gap, we could expect us to go all the way back to the highs, right? So there's rules, and that's how people use their support and resistance levels. I just use it with fair value gaps because there's in fair value gaps is inefficiency. So in fair value gaps, there's going to be some type of reaction, right? So this, you can see this high, this so it's letting us know that I think price wants to go up because you can see every time we're coming up, we're getting these sweeps, and sweeps is what is supposed to inverse any fair value gaps that are opposing. So we have a fair value gap right here. They're all getting violated because of the sweeps. So just be mindful that when you get our sweeps, that we expect the fair value gaps to get broken, right? Fair value gaps to get broken. So you could use it as, this is how you use the inverse fair value gap. So these are my favorite because when you see these happen, it falls quickly. So if you could wait for these setups where you can see, oh, fair value gaps breaking, breaking, breaking. And when we finally break, it's not too late to enter somewhere here on a smaller time frame. This is 30 minutes. It's not, it's still okay to enter shorts to take you to at least an area where we want to sweep. We swept here and we swept here, or we swept here too, right? We're looking for the sweeps. And once the sweeps happen, then you have to be like, okay, I got to get out. Does that make sense, guys? Any questions? Let's see. You put a one, yeah. You put a one in the chat. Any questions? I just want to feel like if this is making sense to you guys, because it is type of somewhat of a different language. Let's see. So right now, everything just looks extremely bullish. But again, it's extremely bullish until it's invalidated. Okay. So right here, we could see that we just keep making higher lows, higher highs. And the one thing that I could do to check if we are going to be bullish is that we just look at the overall market as well. Okay, QQQ is Tesla, Apple, Microsoft, Google, Amazon, Meta, right? It's all of that. And if you look on the 4 hour, this is 4 hour Tesla. This is 4 hour Apple, all-time highs. This is 4 hour Microsoft, which is, this is not the best price action. But if we start scrolling, we could see everything is pushing to the all-time highs. Amazon, all-time highs. Netflix, all-time highs. So that's letting me know that if these continue to push, then why would I want to short NQ, right? That's just my thought process. Why would you want to short it? So let's see where our draw on liquidity is. Look at we keep getting buying wicks, right? There's no fair value gap resistance on this time frame. Maybe this inverse one. That's the one thing to be mindful of, right? But besides that, if price is bullish, we want to just look for we just want to look for price to at least try to make some sweeps. Okay. We want to see a sweep here. So this is another 90 points up. Okay. And if we can break this and continue and use fair value gaps right here is creating a fair value gap. So the next one might open right here and we might push right here. And let's say we close here and then we created a fair value gap right here. And now we can use that to take us to our next right there. All right. And then our next all-time highs. Okay. So, but right now we're inversing this. And it's okay to inverse this. Why? Because we had our sweep. We have our sweep. We can use this as an inverse. Does that make sense? So a lot of times people ask, which fair value gaps do you use? Well, use the one that is supporting the trend. And we inverse the ones that is going against the trend. So this is a downtrend. This is a red fair value gap coming down. But we sweep and we keep pushing up. And everything else in the market is bullish. So we're going to inverse this. And now we're going to use this as a support. And so we take out target one. And then eventually we start breaking and making our way up. We can use this fair value gap or this inverse fair value gap to take us to our target. Okay. So we're just keep using support, keep using support until we take our targets out. After this, we could just continue to rip all the way to the end of the year. We don't know. But if you can just go for these little ones and be done with your day trading and then worry about these external ones by just buying shares and just letting the market do its thing, I think that would be a better position to put yourself instead of FOMOing. Just buy shares if you're FOMOing. And if you're trading, just go for internal targets. Okay. But yeah, any questions? Because that was the main thing I wanted to go over today. So I'm sharing the right screen. I'm sharing the right screen.
ABW.
So
Oh.
is the 4 hour time frame the best time frame to look at for those and the adverse fair value gaps?
Well, you can't trade any smaller time frame without knowing the bigger time frame. So that's the thing, right? You just have to know, you got to know the bigger time frame before you can trade any time frame. But here's an
Right.
example of like, here's the 1 minute, right? So you could trade it. It still works because we have it right here, actually, right? You see an inverse fair value. You see a fair value gap right here,
Mm-hmm.
but we swept right here. So when we sweep and you inverse a fair value gap, then yeah, you could use it like that. So, but the all time frames, it works on all time frames, but you want to know the narrative on the bigger time frame because sometimes you might see this and it goes to like right here and it just keeps dumping. You're like, wait, why did it dump? It's supposed to go up. It's supposed to go up to here, right? We inversed it, we swept, we inversed, and we're supposed to go to here. But sometimes it dumps because the bigger time frame shows that it's just bleeding. So this is just a pullback. Does that make sense? So
Yeah.
a bigger time frame lets you know if it's a pullback or a reversal, and a smaller time frame is the precision of your entries.
Okay.
Yeah, so you have to always like you always have to use the bigger time frames for sure. But when you have a bigger time frame, like let's say a big time frame fair value gap or something, and you're like, oh, this is too big, then you want to go to a smaller time frame and just kind of make it smaller and smaller and smaller, right? So that's what you do.
Roger that.
Yeah, but yeah, just keep marking them out because like that's the one thing that for sure price does some type of reaction. I think everybody who's been in any of my classes or part of the mentorship who've seen fair value gaps now can undeniably say that price always does something at a fair value gap. So I think that you guys got to keep utilizing it, but now understand that why fair value gaps used? It's used to help continue the trend to get us to our objective. And the inverse fair value gaps that I went over today is the internal reversals of the support and resistance. Like we have a sweeper right here for example, right here, the 15 minutes. And that's why when I say precision, right? This is actually a good example. When I say precision of a trade. There's no inverse fair value gaps right here on this 15 minutes, but we see a sweep on the 15 minutes, right? This is a sweep, but how can I get in? A sweep alone isn't good enough. So right here, a sweep alone is not good for a trade. So if you go to a smaller time frame, now you can see fair value gaps you could use. Does that make sense? So right here, like there's no fair value gap, inverse fair value gaps to use. But I saw a sweep here. I see inverse fair value gap here now. And I see inverse fair value gap here too. So that's letting me know that it's being violated. The objective is taken. Let's see what happens. Right? We just inverse this fair value gaps. And it takes us to the next fair value gap up here. It's a magnet, right? It's a magnet. Boom, and you're done. That's your fair value gaps can be targets too. You could just exit right here. Boom. Right when it touches. And then price just does what it does afterwards, right? Depending on the time frame. There's another one right here too. So it looks like it wants to continue up. But let's just see. Hit this fair value gap right here. That's why fair value gaps are targets as well. Don't always go for the external highs. Boom. Right? And then it dumps a little bit. And there's overnight session. And it takes us to our target. That's why it's important to take your profits at fair value gaps, because when it pulls back, you might run out of time in the New York session and it might screw you over. And then after the market closes, and then it hits its target right here. Market closes right here, right? That was 3 in the morning, actually. No, it was overnight. But sometimes it closes right at like power hour, and you're like, oh, it's supposed to go up, but it stopped right there. And then like the next morning we gap up because our target has not been met. So that's why it's important to take it here in your fair value gap so you don't have to worry about it anymore, or at least take partials. When it's moving up, you want to take profit here. Moves up a little bit, you take profit here. Because look at this, drawdown is not nice. And if you have apex, trailing drawdowns is actually going to ruin you. Right? So if you have top step, you could hold it longer. But if you have apex, you have to take profit. And that fair value gaps is a good way to give you a reason to exit. And then we had this little internal sweep here to make us pull back a little bit, scare people out. And then we continued up. But yeah, so hopefully I answered the question for you. Anybody else have any questions that they're trading? Is this class helpful for you guys? But yeah, I encourage you guys all to just, when you guys are on your own, just, for me, I've seen this so many times already, but for you guys, it's probably new. So just keep marking it out. Keep marking it out. And the one thing I always try to stress for you guys is, so when market opens every single week, go on the weekly every single week. I want you guys to do this and send your charts in too. I want to see your charts in I think there's like a members homework or something, right? Or just put it in our general chat. Well, we can all analyze it together. But every week, I want you to mark out opening week price right there. I have a new week opening. Oops, I have a new week opening gap. You could just put WO. That's good enough. WO. That's a weekly open. I want you guys to do that every single week, and you could see that the price right here, it lets you know that when we open right here last Friday or Sunday, right? We came down, we did our sweep, and it's letting us know that when we close right here, is this week green or is this week red? And you'll notice that at the beginning of the week, you'll see how much it hovers around the weekly open, and it acts as an area because this is letting you know that for the rest of the week, where do we want to go? The week closed where we did right here, which letting us know that oops, this is actually not replayed. Let me
Hey, BW, can you say that again? You said go and mark the weekly and then what?
The weekly open,
The
because
weekly
that lets you
open.
know that if the rest of the week, if we're gonna expand up or down. Right here was a ranging week, so it was a little bit tricky week, but you can see how at the end we pushed up. So at the end of the week we closed right here. We had a green week. So I go to the weekly candle. Look at this. It's a green week. You see that? So it acts as a really good area for right here. Let's see this right here. So let's go to just last week alone, just so you can understand, because this week was kind of a smaller inside, like a looked like a smaller week, right? So we have one right here. Let me just delete these. This is a weekly open, right? So throughout the week, you can see how we pushed down. We pushed down and we swept. And once we swept here, oops, right here, we swept here and we pushed up. So for the rest of the week, anything above here is letting us know that we're ripping. We're gonna rip because we completed the objective, and now anything above this line right here is gonna make the whole week green. That's why it's important to mark out the very first print. Just go to your weekly and get the opening, and it lets you know if we're gonna expand and get away from the weekly open, which is right there, right? Boom. That makes sense?
Gotcha. Thank you.
Yeah. Just mark it out and you'll see how much it's respected every time. You see how we bounce, how many times we bounced on this weekly open? So it acts as a significant level, because the week always has an opening, it always has a close, right? So the same thing right here. We had this weekly open, mark it out. Weekly open, pink, right? We need to go to a smaller time frame, 30 minutes. All right, we pushed up, we came down, we swept right here. We swept external or internal sweep. And once we made our way past up, that's letting us know that when we do this, right, we get a sweep here. We should at least anticipate price to go back to the weekly open. So that gives you from here to here. They're always targets from here to here. And then since we have a target here, it's here. So that's why what I'm saying is that when we have our price coming down, let's say this is probably SMT on ES was probably swept, but here didn't, right? So when we come down, we go straight for this, right? And it acts as a very significant level until it starts expanding away. And when it starts expanding away, we know we're running to a bigger time frame target. So let's say if this is the weekly open and we're all the way over here, then we can expect us to go take these targets out because we're so far removed from it. But if we do a double top right here and come down, we can expect price. We can look for price to use that as a target as well. So it's just
Mhm.
a significant level to mark out at the beginning of every single week. At least mark that out. And then like usually for me, I do every day that it happens afterwards. So let's say this is a Sunday open at 15, and then we got a 15 right here on Monday, for example. Then I'll mark out that opening. And then like on Tuesday or something, or Wednesday, we have a 15 right here. I'll mark out this open. There's like I'll just for the new day, I'll have a new one. So I'll have like a like right here, right? And then I'll have it in yeah, I'll have openings. So I'll say opening. So let's just know at least like right here. You see we had an opening right here,
Mhm.
and you see how that level was respected later on.
Mhm.
And you were wondering, oh, this is sweet, but this is the opening price. So every day I mark it out, and it lets me know where it is in relations to uh the weekly, so the daily and the weekly. And sometimes you might find that the on Friday it's all the way down here, so it let me know the whole week we're bleeding. So it's also,
Mm.
it's a good way to measure kind of like it's putting a pulse on the market, on
I
what we are.
like that.
Yeah. So every week it's just kind of reminding you, like, or every day it's reminding you to at least check like where we are, because you should know. And it's a good way to at least like by marking it out, it's just kind of like at least doing the little things to so like because sometimes you might miss it and be like, oh, I keep trying to short the market. Right, I keep trying to. Have you ever tried to keep shorting the market, and we're just ripping, and then it keeps going against you? Well,
Yep.
maybe you gotta look at where we are in the week. All right, so that's the thing too. So just do that. I think in a couple hours, then the weekly open will print at 3 o'clock Pacific, so 6 o'clock Eastern time. It'll print and just mark out the opening price there, and then just watch it for the rest of the week, and then get back to me and let me know like, hey, what did I see? Because there's always something to learn from past previous price action.
Thanks, BW.
You're welcome. You're welcome. All right. Anybody else with any other questions? All right. With that, I will conclude class. Thanks for everybody showing up. Might do another class this week. Try to get with Moody or Pastor or something. And yeah, we'll do a class together or something. So thanks everybody for hopping on. Appreciate it. And have a good trading week.
Thank you. Same to you.
Yep.